During his time at Dragonfly and Octane, lent over £1 billion worth of business.
Yeah, there absolutely was a time when perhaps bridging market was referred to as the Wild West. If that property developer decides to use bridging finance or refurbishment finance, he can spread his capital across more projects, possibly 2 or 3 projects.
What is bridging finance? Today we're going to break down what you need to know about bridging finance from a lender's perspective. My name's Malkit Purwal, one half of Savoys Properties with my business partner Sanjay. We've been in the property game for 23 years. We now manage over 700 tenants. We've been specializing in HMOs for the last 14 years and commercial to residential conversions for the past 11 years. Today we're actually sat here with Justin Cooper from Octane Capital. Now Justin's not a regular business development manager. He's actually, during his time at Dragonfly and Octane, lent over £1 billion worth of business through both of those organizations and is one of the most respected business development managers that are out there. Now let's just dive straight into it. What is bridging finance and why is there a need for bridging finance?
Okay, yeah, it's a really good question and actually one that before I joined this industry I didn't know the answer to myself. But pretty much as the name suggests, it's a method of getting you from A to B. If someone wants to buy a property before they do something else to it, so if they want to buy the property before they refurbish it or convert it into something else, they would use a bridge. So it's not like a mortgage. It's only designed to be there for a short period of time. And often when you can't get a mortgage on a property because the property is uninhabitable, someone would use a bridge to make that acquisition before it's subsequently repaid either by sale or buy to let.
Now for us, bridging is actually quite a useful product, but I'll be honest, when we first heard the term bridging, and there's a lot of horror stories with bridging, you know, and I know certain lenders have changed, rather than calling it bridging, they'll call it short-term lending or refurbishment finance. Now, where did all these horror stories come from, and has the industry moved on from there?
Yeah, there absolutely was a time when perhaps bridging market was referred to as the Wild West. This would have been right back prior to the last property crash. And basically I think that reason that bridging got that reputation was because there wasn't a lot of due diligence done. The lending was very expensive, very high penalties for defaulting, and it became, you know, at its time was a dangerous thing to get into because you were exposed to some pretty expensive financing if things didn't go to plan. But gradually over the years this market has begun to recognise a proper use for bridging facilities, and perhaps the reason for people coming up with alternative names is to try to take away some of the stigma that was associated with bridges from 15-20 years ago. But absolutely, particularly in the regulated world, you know, bridging lenders now are actually regulated by the FCA. In the non-regulated world, I think it's been agreed that really, you know, these loans should be treated as serious business tools, and as you say, they're something that you value very highly and use a lot in your own business. That's the case for many property investors.
You know, for us, when I'm trying to break down what a bridging loan is and the use of it, I try to explain it to individuals like a credit card. Say, well, you know, if you have a credit card and you basically use it, you get your 56 days interest-free credit and you repay it at the, you know, when your bill is due, it's actually quite an effective form of credit. And effectively that is the same with a bridging loan for us. If we know we can add some value to a property, we know we can't get a buy-to-let mortgage on it because we're going to have to undergo work, so you have to go through a bridge, but there's a significant uplift, then bridging for us is a very useful tool. If we use it and repay back that loan within 6 months or 12 months, it's actually quite an effective tool. Now, when it comes down to taking a bridging loan, does it differ from a normal residential or buy-to-let loan, and when it comes to affordability, what do lenders look at?
Yeah, okay, that's a really good question. Yeah, bridges are very different from when comparing to mortgages, certainly from an affordability point of view, what you'll find is that most bridging lenders will incorporate the cost of the finance within the loan. So you can service a bridge. Obviously, servicing a bridge is more expensive than servicing a mortgage because bridges, by the nature of their risk, are more expensive. So normally what the lender will do, they will include the interest within the loan. So you will borrow a gross amount and you will actually take away a net amount. And really the difference between the gross amount and the net amount is the interest, the cost of that loan for the period of that loan, and any fees associated with that loan. So affordability doesn't really come into it. The amount of lending that you can borrow will very much depend on the nature of the property you're purchasing, where that property is, and that will determine the leverage that's available. So if, for example, you can borrow 70%, you might find that what you'll net, so what you'll walk away with, or what will actually go towards the acquisition or the refinance, the net amount, would be somewhere more like 65%, and that 5% difference would be the interest and the fees.
Now, when people take a bridge, does the condition of the property have any bearing with the loan?
Okay, again, yeah, another good question. Clearly, as we said earlier, the purpose of the bridge is to allow people to do refurbishment, and you can get a bridge when a property is actually inhabitable. So to some extent, the condition of the property doesn't matter. Doesn't matter if it doesn't have a kitchen, doesn't matter if it doesn't have a bathroom. So there are circumstances where the condition of the property is not so relevant. You can't take that too far though. A bridging lender wouldn't want to lend if a property was at risk of subsidence, unless there was a specific plan in place to rectify that problem. So in the main, the condition doesn't really matter, but there are limitations.
When it comes down to actually taking this loan out, how much are you able to borrow?
Yeah, okay, so to determine the level of borrowing will vary from lender to lender. There'll be what we refer to in the industry as an appetite, a leverage appetite. And again, that depends on whether that property is residential, whether it's commercial, whether it's mixed use, the size of the property. So generally, lenders refer to liquidity. Okay, what they mean by that is that if a property is particularly liquid, it's very easy to dispose of. So from the lender's perspective, if they took that property in and had to sell it, if it's highly liquid, they could sell that property more easily. That would encourage them to lend at a higher leverage, say 70, 75, up to 80% loan to value. If a property was illiquid, so we would all love to live in a £5 million 6-bed house with a swimming pool and 3 acres of land, but how liquid is a property like that? How easily could you dispose of a property like that? And so because that would be more illiquid, less liquid, the leverage on that property would likely be lower, more like 50% loan to value. So that's generally what drives the amount you can borrow.
Now, do you have to have a certain level of experience if you're going to take a bridging loan with yourselves?
Okay, so as a lender, we're quite happy to lend to someone on a bridge basis if it's the first time they've done that. What we lend on, the basis upon we lend does to some extent depend on experience. If someone wants to start converting the property or turning it perhaps from a house into an HMO or from a house into flats, then we are going to want to know that they've got some experience in doing that. We will also provide the funds to do that conversion, but we would still like to know that those works are being carried out by either someone that has experience or at least a builder that has suitable experience.
For those that don't understand, if someone was going to approach you for going through a bridge, what are the processes and steps they'll have to go through?
Obviously, one of the main things that we're dealing with today is AML, anti-money laundering. So we're not going to lend 100%, so they will have to have cash of their own to put into the deal. And it's our responsibility as a lender to understand the source of that cash. By that, we generally just need to understand where that wealth has arisen from. So some people might come and they may have sold a previous investment property. Fantastic, very easy to underwrite. All we want to know is the details of the property that they previously owned, a completion statement from their solicitor, and a bank statement showing that money going from the solicitor to their bank. That's one example. We would do normal identity checks, so just a copy passport and a proof of address. They should have their own solicitor. We would have our own solicitor, and it's a solicitor's responsibility to do all the due diligence on the property that they're purchasing or refinancing. That's pretty much it.
How important is a valuation report?
Yeah, so the valuation is extremely important. In most scenarios, most lenders are going to require a valuation. And what that valuation will do, it will provide the lender with an indication of what they believe that property is worth based on that surveyor's own due diligence. So that surveyor will look at sales of similar properties in the area, and they will use their expertise as a surveyor to advise us on the value of that property, and we will then legally rely on that valuation report.
How many types of finance products do you guys have?
Yeah, well, so bridging for us is primarily used in 3 different ways. So there's a plain bridge, so someone might go to auction, and when they go to auction, they win a property at that auction. They've then got 28 days to complete on that. Now, it's very difficult to get a mortgage on a property in 28 days, but quite easy to complete a bridge. So that's probably the traditional reason for a bridge, speed. We then have a refurbishment product. So that will include some money towards the acquisition or refinance of the property, plus we will provide the funds to convert that property. We call that a refurbishment loan. And then finally, we have a product that we refer to as a dev exit or a development exit. That scenario is perhaps a developer has taken development funds from a bank to build 3, 4, 5 or more properties. There's been some delays along the way, which can often happen, some delays due to weather or due to supplies or builder restrictions. Builder gets to the end of the term, his properties are finished, but his loan is due to expire in a month. He can't possibly sell all his properties to repay that loan in a month, so he takes developer exit from a lender like Octane. We repay the development lender, we give the builder a whole new 12-month term to be able to sell his properties at the best price he can achieve and pay us back.
Now, for those that are out there, what type of fees and costs are associated with a bridging loan?
Yeah, okay, so again, these all vary from lender to lender in the industry. There seems to be a bit of an industry average of a 2% fee to get into a bridging loan. There generally is no fees with most lenders to repay that bridging loan. So unlike a buy-to-let loan that might have a fee on the way in and a fee on the way out in the early years, there's generally no cost to get out of a bridging loan. And the interest rate, again, that will very, very much depend on the lender that you're using. There's fixed rates, there's variable rates. At the moment, I would say a good average for the industry is probably 0.8, 0.85% a month. So you can see that that does cost more than a buy-to-let mortgage. But of course, as we said in the beginning, that's basically because of the associated risks with a bridge that you don't traditionally get with a buy-to-let.
Now, with your 11 years of experience within the bridging world, have you seen the strategies that developers, people taking these bridging loans out, has changed?
Yeah, I think over the 11 years since I've been involved in the bridging industry, I think developers have come to realise on the use. You know, you referred to it earlier. It is a form of credit. You know, if a developer is cash rich, he might have, you know, £200,000-300,000 that he wants to put into a project, but probably £200,000-300,000 with cash alone might fund one project. Whereas if that property developer decides to use bridging finance or refurbishment finance, he can spread his capital across more projects, possibly 2 or 3 projects. And ultimately what he's doing is he's using a combination of his own money and a bridging lender's money. And even though he has to pay for that bridging lender's money, it allows him to make a much higher profit on each of those projects and ultimately, in the long run, more money.
So have you seen like an increase in people wanting to do now like HMOs and commercial to residential conversions as opposed to normal just house refurbs?
Absolutely, yeah. Very, very specifically since the interest rates increase, because you know, from a landlord's perspective, if the interest rates have gone up, the cost of his finance on his buy-to-let property has gone up too, and it's just not that easy to be able to increase the rent for their tenants, especially if they're not on, you know, especially if they're on new ASDs. So those property developers have been looking for ways to increase the yield, their return on their investment, and absolutely the best way to do that is to turn it into flats or an HMO, large HMOs, and that's a real sweet spot for us, and so that too has particularly helped an increase in our business flow, certainly in the last 12 months.
A lot of the loans that come through you guys, how do the majority of your clients exit? Are they refurbished? Are they going on to term products, or are they selling these sites on, or is there a mixture? And in percentage-wise, roughly, you know, where is the ballpark on it?
A lot of investors, especially if they are going to the lengths of converting a property to an HMO, are doing that with the purpose of keeping that property within their portfolio. So they will generally repay us by means of a refinance to a bank or refinance to a traditional buy-to-let lender, and they'll hold on to that property. Some clients do just want to do a conversion with the aim of just making a return on that individual project, and so they will sell that property and we will be repaid from the sales proceeds. Obviously, generally with a development exit loan, those are prime absolutely for sale, and so in those instances. With regards to percentage mix, I would say more recently a larger proportion of investors are beginning to hold on to their assets now, and so we are being repaid by a refinance more often than we do sale.
Okay. Now we've seen, since a lot of the prices and interest rates went up since Liz Truss initially came to power for those 45 days, we've seen a lot of developers have projects that may not have gone right, and these have been offered off market to us. Do you see some of these deals coming to you guys and where you're actually lending on them?
Borrowers will come to us and say that they're buying a property at a particularly good price. We call that a below market valuation, and there certainly are circumstances where that really is the case. There might be people that have got themselves in trouble, they've found that they're out of their depth and they really just need to sell that property to maybe just wash its face from their perspective, and that might lead to another investor getting that property at a good price. If that's the case, then we're happy to support that, and of course we will lend off the value of that property. So that might mean that we're lending, instead of lending at 70%, we might be lending at 85% of the price that they're paying for that property, but of course as long as it's not more than 70% of its real value.
And in terms of a lot of the clients that are trying to exit, do you see basically some areas where the market has sort of shifted and some areas where, you know, these properties are selling well? So I'll give you maybe an example, houses and flats. Are you seeing any difference in terms of exits, in terms of sales, and difficulties people may be facing?
What we do see quite frequently is the borrower, quite understandably so, will generally be quite bullish about how quickly they can sell their properties. We have to take perhaps a more pragmatic approach in those situations, because, you know, the market in some places, perhaps more so on the high end of the market, it is beginning to take a little bit more time. Sales are starting to take a little bit longer to go through. Borrowers have to accept the fact that, you know, it's not 100% given that they'll put that property on the market and it'll be sold within a few weeks, especially if they've got multiple properties. Perhaps not so much at the lower end with flats. Flats might you know, be coming back to that terminology I used earlier, liquidity. Flats are generally quite liquid as long as they're not, you know, the high end £2 million, £3 million flats. Yeah. A traditional flat are generally more liquid and can sell more quickly. But my advice primarily would be that borrowers have to be realistic about how long they might need, because when they take out their finance, they need to ensure that they've got a sufficient term so that they're not getting to the end of their term and realising that they need longer.
Now, obviously, we've got an election in the horizon. With potentially a changing government or the existing government staying in place, is there a few areas where you think will initiatives that will actually stimulate the market? I'll give you an example, maybe like stuff like Help to Buy or stamp duty. Do you see the market actually needing something to actually give it that edge and, you know, sort of bounce back?
Yeah, I mean, primarily, obviously, in the residential market, there's clearly has been a high demand for support to first-time buyers and getting people on that first rung of the ladder. It would be good to see that whoever ends up in power, there is some kind of incentive put in place to support people at that bottom end of the market, because, you know, otherwise, without a hefty deposit or high salaries to be able to support the higher interest rates on their first mortgages, you know, first-time buyers are and always will struggle to get, you know, without banker mum and dad, you know, to get on that first rung of the ladder. And we do need that impetus at the bottom end of the market, because of course that in itself creates stimulus further up the chain. And so, you know, once that comes into place, I think that would be very good for the industry.
Earlier this year, 99% mortgages were bandied about and it's gone very quiet. Do you see a market for 99% mortgages, or do you find it's going to be difficult for a lender to actually provide so much leverage?
From a personal perspective, having myself been in a situation where I experienced, you know, I'm 56 now. When I bought my first flat, I experienced negative equity. Okay, I bought my first flat for 55,000 with a £52,500 mortgage, and a year after I bought it, it was worth £45,000. Oh. It's not a nice place to be in. So I would suggest that, in my opinion, it isn't. From a lender's perspective, I don't think that it's the right thing for a lender to do, to lend someone as high a leverage as 99 or 100%. You know, even 95% really is pushing the boundaries, because it doesn't take much of a move in the market. And we have obviously in recent years seen COVID, the Ukraine war, interest rate increases. These affect the market, and they affect the market to move, and it might only move 5%. Well, if you're borrowing at 70, 75, 80%, a 5% shift in the market doesn't affect you too seriously. If you're borrowing at 99, 100%, a 5% shift will put you into that negative equity position, and that can only be a bad thing for the market.
Well, thank you, Justin. It's been amazing. If people want to get in contact with you, what's the best forms?
Well, if anybody wants to get in contact with me or Octane, just take a look at our website, octanecapital.co.uk. In the Meet the Team section, you'll find me, but there's a phone number there, and if anybody wants to get in touch for us to discuss possible deals with them, we'll be happy to do that.
Now, we hope you enjoyed that video. It's actually been very insightful. I've actually learned a lot on bridging finance myself from Justin. We've actually created a school community with over 550 property investors. It's an active community where we're actually doing weekly calls, and it's an opportunity for you guys to actually learn, communicate, network, and find out more. Now, if this is of interest to you, check the link in the bio. And if you've enjoyed this video, hit the like button, leave a comment, hit the bell icon, and we'd like to see you on the next video.